Everything is done through relationships. And in the note industry, there is certainly no difference there. If you want to be successful in this business, you should get good at building relationships and nurturing them.
Welcome to Truly Passive Income. I'm Neil Henderson.
And I'm Clint Harris. And today we're joined by Fred Moskowitz. So he's a seasoned expert in mortgage note investing with over a decade of experience turning alternative investments into consistent cash flow. From transitioning out of a tech career to educating investors through his book, The Little Green Book of Note Investing, Fred has helped many move from paycheck dependence to building long-lasting financial freedom. Fred, thank you for joining us today. How are you?
Doing wonderful. Thanks for having me on today.
Absolutely. So Fred, before we dig into your background, I never want to assume that somebody tuning in for the first time understands what note investing is. I know what it is. Clint knows what it is, or at least he claims he does. But for our audience that's maybe tuning in for the first time, has never heard of note investing, give us a high-level overview of what note investing is.
Yeah. Well, note investing is referring to mortgage notes. And so a lot of people don't know that individual investors can buy and own mortgage notes. They're available for sale on the secondary market. And I'll tell you something, a lot of people like to talk about investing in real estate, whether they're involved in it or not, right? And there's so many asset classes. You got single family houses, commercial property, multifamily, vacation property with short-term rentals. But what if we spend some time talking about investing in the paper? The paper is the debt. We're investing in the notes and mortgages associated with all of those properties. And you guys know as well as anyone else, the way to really accelerate real estate investing is using leverage. And so there's all that debt. And it's a really interesting part of the real estate business. But what I've found is that a lot of real estate investors, they don't pay any attention to it at all. And for most people, when they think about a note and a mortgage, they think about it from the perspective of being the borrower and not as being the lender. And so what we do with note investing is this allows us to step across the aisle and become the bank. And when you do that, you get to transition from being the one making the monthly payments to being the one receiving the monthly payments. And that's what note investing is all about.
Yeah. So to me, when I hear someone talk about note investing, this immediately screams veteran strategy to me. This is not something that you hear people doing right out of the gate. This is something typically, I remember my first experience was years ago talking to somebody about, oh yeah, I've got this property. I'm putting these types of units on them. I'm actually seller financing them. And then I'm just going to flip the paper to recapitalize. And I was like, wait, what was that last section there? And he brought up the idea of buying and selling the paper that these notes are established on. And to me, it kind of at the time, like Neil and I are self-storage operators, but we have investors that invest in our deals as limited partners. All they have to do is put money in and sit back and watch, but they still have a general partner that's actually doing the work. And actually we have to operate and execute the business plan. And then it kind of like but for those limited partners, it's very, very passive. From there, it kind of reminds me of like a mobile home park where people take the mobile home and they sell the mobile home units back to the tenants, right? So they actually own the mobile home. And then it's their responsibility to take care of it. They have to take care of the maintenance and everything else. And you're just owning the piece of land and connecting the lot rents. And then like, to me, this is even a little bit more passive. Like they own the land, they own the property, they're doing the maintenance, they pay the taxes. You are literally just the bank. You're sitting there collecting their monthly payments. And if they ever default, you're foreclosing on that. But you are essentially the bank in this situation, right? They're paying.
You're the lender. Exactly.
Right. So how do you find yourself in that situation? Are you typically selling notes to the bank? You're buying notes from the bank. You're putting a tenant in place and then using this strategy to recapitalize. How does that work?
Yeah. So what you're talking about, those strategies of creating owner financing, which, by the way, you talked about the case of mobile homes, but also with single family homes. Successful investors do this every day as well. And so that's one area of note investing. I focus on buying debt that exists already, institutionally originated debt that comes from banks and lenders. And most people know there's this huge secondary market where loans are bought and sold every single day. Undoubtedly, just about every single one of you out there listening, you've had this happen where you buy a property or you refinance a property, and then you go to closing, you sign all the loan documents. But then wouldn't you know it, after you've been making your payments for a couple of months, maybe 3 to 6 months later, you get that letter from the lender saying, "Dear Mr. or Mrs. Homeowner, we're writing to let you know your loan has been sold to another lender, and here's their contact information, their address, and starting next month, please begin making your payments to the new lender." And so they sold that loan to recapitalize. And why did they do that? Because the very next day, they're going to turn around and originate a new loan for someone else. And that's their business model. And so we have this secondary market. Loans are bought and sold every day. At the top level, Fannie Mae, Freddie Mac sells so many loans every quarter. You can go on their website and see it because it's publicly disclosed, all the loan trades. But then there is a propagation where it goes from the big Fannie Mae, Freddie Mac down to funds, different mortgage-backed securities. Wall Street gets in there. There's other note funds, hedge funds buying and selling notes. So a lot of times when we buy mortgage notes, there might be 6, 7, 8, 9, 10 prior owners in the chain of ownership. And we see that just like you can see the chain of ownership on a property. You can also see the chain of ownership on the debt as well.
And to my understanding, just like in real estate, there's distressed properties that that you're buying and adding value. There's those sort of gold standard, almost turnkey properties that, maybe you're not going to be all that profitable, but they're a little safer. And there's the same happens with notes as well. You can buy non-performing notes and then try to convert them to a performing note. There's going to be a little more risk involved in there, but because of that, you're usually able to buy it at a discount, which then allows you to create a higher margin, higher return, correct?
Yeah, it's that classic risk reward ratio. The pricing of notes really varies depending on what your risk tolerance is. For me and our portfolio, we like well-performing notes. That's what we seek out. And so, that's our business model. But like you said, there's so many different niches and different areas. And in general, I would say that the more willing you are to take on risk and solve a problem, then you can earn higher rates of return. And so, that's probably not for someone that's getting started, but as you have more experience, your risk tolerance changes over time. And that's the normal evolution of an investor with any asset class, right? You can take a asset that was not managed well or that has some issues, but you have the knowledge and skills and the team to go in and correct and resolve the issues. And now you've increased the value of your asset in doing that.
All right. So you're the first person that we've had on that we've had the ability to really dive in on this. We also have a limited amount of time. So I'm coming from an extreme place of ignorance on this. So I'm going to throw some questions at you and just make a few assumptions. You tell me where I'm right or where I'm wrong. To me, this feels like something that you don't really dabble in. You either do this or you don't do it, right? Because to me, it feels like there's inherent risk here. You've got 10 years of experience. You've also got a tech background, and you come from a place of understanding how things work, and you're in it. And this is your space, and you're doing this. This doesn't feel like, I'm going to go buy one or two notes and see how it goes. In terms of everything, like, are you picking these individual notes based upon your criteria, or do they have like a grading system where you can see what kind of quality note this is? Or my assumption is you're not going and searching through the haystack to find these needles where you're like, oh, this is a good one, we're going to keep this. You're probably lumping a group of these together basically to create the equivalent of a mutual fund, right? So you're protected across different assets. Is that right?
Yeah, you can purchase notes individually, one or two, but a pool is what you're referring to, which might consist of 5 or 10 or 20 or 100 notes, right? And so it is a good best practice to perform due diligence on each asset and analyze and evaluate it before purchasing it. But you can certainly buy individual notes or multiple notes at one time. And like anything else, when you buy in bulk, you can negotiate better pricing, better discounts. And so it depends what level you're at in purchasing. But back to your first point, yeah, this is not something to dabble in. It's a full-on business. However, if you're someone that doesn't have a lot of time because you're seeking a passive investment, you can invest in a note fund instead of building up a portfolio of notes. And that's more of a passive approach where the fund managers go and they'll raise capital, and then they will go out to the secondary market, buy the notes, analyze them, perform the due diligence, manage the portfolio. And so you have different options depending on how much time you have and what you want to be, your level of involvement. And there's no right or wrong answer. It's a very personal decision. And I've seen people be successful at all levels, both as passive investor and active.
There really are so many different flavors of notes out there that it feels like you can kind of tailor it to what you're looking for. Let me ask you this. I don't even know if I'm asking this question the right way, but it seems to me that if you're investing into notes, there's going to be cycles in that market, right? And 2 years ago, when we had interest rates of 2.85 to 3.5%, that probably, to me, feels like not a great time to be purchasing notes versus in a higher interest rate environment. Seems like that would be a more lucrative time to purchase notes. And am I right or wrong about that? And how does that, like, are you sitting there looking at the market cycle and as long as there's movement, you're okay? Or are you really looking at, you can capitalize in those higher interest rate markets, but also understand that might bring up risk because those people are going to be incentivized to refinance to a lower note amount, which I guess then it just means you get paid off. But talk to me about the dynamics of the interest rate environment.
Yeah, the interest rate environment certainly comes into practice. However, there is always movement in the marketplace. There's always a need for liquidity, and so loans always get bought and sold. Now, when there's a low interest rate environment, what happens is that drives greater discounts. And so purchasers of debt are always looking for yield, and they'll adjust, pricing will adjust based on what the interest rate is. And so that's certainly an impact. Now, for us, we buy a lot of notes that were originated multiple years ago, not last week or last month. And so it's less susceptible to interest rate fluctuations. And you can really pick and choose what you're looking for. But definitely when there's a lower interest rate environment, it does affect the pricing and the discounts are greater in that case.
So over a 10-year period, if somebody's going to invest into like a note fund type deal, what type of returns are people historically looking and maybe that's a 10-year, maybe it's a 50-year question, maybe it's a 100-year question. But for some perspective compared to other alternative assets, and keep in mind, I love the fact there's no maintenance involved. Like, this is a very passive strategy, and I'm assuming that the risk and the reward are tied together. And the riskier the note is that you're investing in, probably the higher return over time, but also the higher chance that they could default on the loan. But across the board, historically speaking, what kind of returns are we talking about with note investing?
Yeah, this all comes down to individual risk tolerance and what type of notes you're investing in. But to give you some perspective, if an investor was looking for super safe, well-performing notes with a lot of equity coverage and good track records, you are going to be looking at somewhere between 6-7%, 8% rate of return. And then as the risk tolerance goes up higher, now we're getting into 8%, 9%, 10, 11, 12. Maybe you become interested in investing in hard money loans, which are for investors. Those are now in the 12 and 14% area, and we can keep going with higher risk. And so that's all out there. It's all available. And it comes down to, for each investor, the first question we ask is, what's your risk tolerance? And for someone just starting out and brand new, I would say stick with the safer notes, lower return, get started with that. And then over time, as you build up your experience and your expertise, you can branch out into higher performing returns.
All right. So we sort of jumped right into the nuts and bolts of note investing, and we never really had a chance to actually find out what your background is and where you're coming from. You came from a tech background. How did you find your way into note investing? It's not the typical thing, that somebody finds. Maybe, I mean, unless you're hanging out with us real estate nerds, it's not usually the kind of thing that people know much about. How did you find your way into note investing?
Yeah, the way I found my way was that I was working as a computer engineer in the technology and sector, working in a lot of different startups and tech companies. And it was a wild roller coaster ride. And this was during the dot-com boom days, right? But then we experienced the bursting of the dot-com bubble and the September 11th terrorist attacks. And so through all that turmoil, I realized that I was taking on this huge risk because I was relying on the paycheck from my job as my only source of income. And so I was seeking to diversify my income, because your paycheck, it can be pretty risky. We don't learn that growing up. We kind of learn the opposite of it, but absolutely your paycheck can be very risky because you never know if the company gets acquired or company goes under or the industry you're in goes to the bottom of the market cycle. And so what I learned was I could quickly lose my job through no fault of my own. And it didn't matter how talented of an engineer I was. And so that led me to getting involved in real estate, building up a rental portfolio. I wanted cash flow and alternative sources of income so that whether I was working or not, I would have that cash flow and income stream coming in. And over the years, I started to learn about some of the concepts you mentioned in the beginning, the owner financing strategies and different areas of investing in debt. But then through some relationships I had, I started to learn more and more about note investing and had a chance to buy notes that were institutionally originated paper. And so that was my foray. I started that back in 2010, and it's been a wonderful journey since then, building up a portfolio and really getting active in the note investment community.
Yeah. In fact, you wrote the book, The Little Green Book of Note Investing. This is something that to me, you hear about this, but it's hard to track down anybody who's really involved. So I'm looking forward to getting that book and listening to it. Do you have it on audiobook, by the way? I shouldn't put you on the spot about that. All
no,
right.
it's available printed. And thank you for asking. The book, I really enjoyed that project because it's a chance for me to share the message of note investing and the benefits of it, and really provide a high level overview into an industry that not too many people know about. And so really it was to elevate the awareness of the investment community to say, hey, here is this powerful asset class. And there's a lot of ways to get involved, whether you have a lot of time or not, whether you want to be hands-on or not. And so that's the message in the book. It's a overview of the entire industry and business and how to get involved, how to get started.
So the book is tailored. You said it's sort of tailored for, people who maybe want to dig in and get their hands dirty and learn how to do note investing actively. But it's also sort of a high level overview for perhaps, people who are more like our audience that are looking for ways to invest in notes, passively, but just have some education before they do that.
Yeah, absolutely. Education is so important. And whenever I speak with investors, we have these conversations all the time about, hey, does it make sense to get involved actively in notes or become a passive investor, invest in a fund, which can be a great option. And so it takes some introspective work to decide which one is the right path to go. And like I said, there's no right or wrong answer. It's a very personal decision.
We talk to investors every day who, have some level of interest in real estate or alternative assets. They're busy professionals, they're hopefully earning a good income, whether they be a white coat professional or a engineer or a software engineer. And so often what it comes down to is like, what's your bandwidth? Somebody, they see, they see these returns, that people are making in real estate and they've got some interest and they go, I could do that. I'm going to buy a vacation rental and I'm going to self-manage it. Or I'm going to buy a self-storage facility. I remember a couple of years ago having a conversation with a group of doctors who all went in together on a small self-storage facility, and they owned it for a year and they're turning around and selling it because they underestimated the work involved in it. Now
that's it. It's about partnering with an operator that is going to be skillful and masterful at managing that asset. And if that's missing, or if that piece fails, the whole deal can fall apart, right? It doesn't matter what the asset class is, whether it's notes, whether it's a commercial strip center or self-storage or anything else. The folks managing the asset have a very important role. It's critical. And, that, like your example, that group of people that came together, if they didn't have that piece, then it causes a lot of strain.
I want to dig in on that a little bit in terms of the actual business of what you're talking about. We all know single family home, duplex, self-storage, car wash, doesn't matter. Any piece of real estate is only going to be as good as the person operating it. And a lot of times any financial decision is only going to be as good as the due diligence that you ran on it. So let me ask you, I want to ask about the due diligence question that you brought up earlier, but also, like, if you buy a note from someone, my expectation is that they're not dropping a check in your mailbox. Are you then becoming a mortgage company and you have to have a portal set up and something like for them to be able to log in and make payments? Or like, how does the business side of that work before you just like decide you're going to jump in? And then on top of that, you mentioned the due diligence. I'd love to hear about some of the due diligence that is expected. And also, like, let's think back to 2008 when the mortgage industry crashed. I'd love to hear about the experience there as well.
Okay, this is going to be a 3-part podcast.
Yeah, sorry. I don't have much time.
I'll keep the answers brief. So the hands-on management of the note, that's handled by a servicing company. A servicing company is one of the most important vendors we have in the note industry, and they do all of that hands-on work, collecting the payments. They keep track of the accounting on the note and the amortization schedule. They send out the end-of-year tax forms that have to be sent out, and they handle compliance, which is also very important, state by state. And so that is critical. And so we have all of our notes boarded with loan servicing companies, and they do a lot of that heavy lifting. So that's key for sure. Now, as far as due diligence, on notes, you perform due diligence on the property, looking at equity, the property value, as well as the borrower. What's their credit history, employment history, and we look at what's the track record on the note. The seller of the note will have a payment history to provide to you that you can look at and evaluate. And so these are all important aspects that we look at. And in my book, I have several chapters dedicated to due diligence, how to perform due diligence, what's involved, whether you're analyzing an individual note to purchase, or maybe you're performing due diligence on a note fund that you're thinking of investing in, and how you go about doing that.
So how does it work for a passive investor? At a high level, we can't get into specifics. But if someone is out there looking to invest passively in notes where they're teaming up with an operator, how does it work? I mean, I'm sure there's a whole gambit, but in general, what are the minimums that they're going to see, all the way up to time frame and returns?
Yeah. So note funds, there are many different configurations. Most often they're set up similar to a real estate syndication where there's a private offering. Investors come in, join the fund through the offering, and then start receiving their returns. Now, as far as minimums, here's what I've seen in the marketplace. Generally, note funds have a minimum of 50,000 to join in, and then it goes up from there. There's 50,000, 100,000, 250,000, and goes up. And so it's a matter of looking at different options and seeing which is going to be the right fit for you. As far as time frames, those really vary. If you're investing in, some funds may have a 1-year time frame, or 3 or 5. It really varies. And so when you're evaluating funds, you want to be mindful of what is your time horizon, right? Maybe if you're investing out of a retirement account, your time horizon is much greater than if you are investing with the mindset that you want income from that right now. And so you're going to want to look at that and take that into account.
You're talking about a 1 to 3 year time horizon. So a lot of these, you're buying a note because it makes sense right now. You're getting a good yield on it. The price is where it needs to be right now. You're going to hold this 1, 2, 3 years, and eventually you're going to sell that paper to recapitalize and pay out your investors if they need a liquidity event in 1 or 2 years. You're not really like buying these and holding them all the way to maturity.
You can,
at least most of the time.
No, you can. You can certainly do that. The thing that comes into play with all of this is this following statistic, that in the United States, the average lifespan of a mortgage note is 5 to 7 years. And it doesn't matter if it's 15-year mortgage or 30-year mortgage. What happens is that people have life scenarios come up. They want to move into a better school district, or they need to relocate for work, or they need a larger house or smaller house, or any number of scenarios. And so people will move and sell their property, or they'll just refinance because of the rate environment, or they want to pull cash out of their equity. And so you never know when a note's going to get paid off. It's an element of randomness that comes up that we have to deal with and navigate. So for us as note investors, the idea is that when capital comes back in, then we have to redeploy that capital as quickly as possible to keep it at work as much as possible in a highly efficient manner. Because when you're sitting on cash, the rate of return of that is zero. Or if you consider inflation, it's actually negative, right? So you want to minimize that over time in your portfolio.
Yeah, you've got shelf pressure to turn around and get those dollars back out and earning as quickly as possible. And you might have 3-4 people refinance all at once, which is great because you get paid, but now you got to turn around and put that capital back to work because you still owe, or whoever the operator is going to own a preferred return if it's in a fund model, or whoever the investors are that put their money in. They don't care if the money's deployed on a mortgage or not. They still expect their return. So you better turn around and get it back out there as soon as possible.
Or even if it's just yourself, you have your self-directed retirement account with notes in it. You want to keep that money at work. If it's sitting there in cash, it's not doing you any good. It's not building and building compound interest, right? You know that famous quote from Einstein that compound interest is the eighth wonder of the world. I mean, it's powerful. And so you want those forces working in your favor, not against you.
Yep.
So you mentioned self-directed retirement accounts. That is something people can invest in funds using self-directed retirement funds. And my understanding often is that it's not going to incur UDFI or UBIT. Is that correct?
And anyone can own mortgage notes in a retirement account. Actually, if you speak with a custodian, if you have a relationship with self-directed retirement custodians, and you ask them, they will tell you this, that the most commonly owned asset for their account holders is notes. Whether it's people that are originating notes or buying them on the secondary market, that's very common. And so lending does not incur any of those taxable scenarios that you're speaking about. And note funds don't as well. It doesn't incur that. Now, I'm not here to give, this is getting into the area of tax advice. So I would encourage everyone consult with your CPA and tax advisors. But generally speaking, no. Lending is the business of lending, the business of debt, owning debt is very popular in retirement accounts for that reason.
All right. This is feeling to me like there's opportunity here for people that know how to navigate this, especially in challenging times, like in really stark buyers or sellers markets, or when interest rates are high, or it's hard to get financing or things like that. Post 2008, not a lot of banks were lending money, right? So is this a scenario where if I know this, I can go make deals work that wouldn't work for other people? Because it might be hard for me to go to certain banks are going to be, they're tied up. They're not lending right now on storage or whatever it may be, but I can go to a seller. I can navigate. Probably the smart thing to do would be call someone like you first and be like, Fred, I have questions about the leverage we should put on this, the interest rate we should put on this. What's going to make this an attractive note that could sell on the secondary market? How do we structure a seller finance deal where I'm putting down 30, 35%? So it's going to be 65 or 70% LTV with X interest rate, with this many years, this many balloons, whatever, that I can make sure that I can get the deal structured with that seller, and then they could turn around and sell the paper and be made whole if the deal is structured the right way, even if I couldn't go get that from a bank. Is that fair?
Yeah, absolutely. Absolutely. And a big part of this is building that relationship with your buyer who's going to buy that note. And so you're going to have a relationship with them, and ahead of time, you can ask them, what do you look for? What are the things that are important for you in the note? And then you take that into account when you structure the financing. And so absolutely, that is the whole idea of delivering to the marketplace whatever the product is that fills that need, that is in demand. And so when you can custom tailor that, that can be very powerful.
I love that.
Now, Fred, you mentioned when we're offline that you've got the book, the Little Green Book of Note Investing, but you also have a community where you help other sort of people with engineering backgrounds sort of navigate the note investing world. Tell us a little bit about that community and what it's all about.
Yeah, thank you. This is something that really goes for any type of investing, right? It's building a community of people that know each other, that want to help each other, and that know people that want to help each other. Everything is done through relationships, and in the note industry, there is certainly no difference there. Note transactions are handled oftentimes through personal relationships. And if you want to be successful in this business, you should get good at building relationships and nurturing them, because it's a small world. The note investing industry, we all know each other. And so it's all about being top of mind and being good at building and nurturing relationships.
What's the community called?
Yeah, the community is called Investing Secrets for Technology Professionals. And, anyone can get in touch with me to find out more about that.
With the exception of Investing Secrets for Technology Professionals, and the exception of reading the Little Green Book of Note Investing, for myself and other people interested in this, if you're starting off from zero, what's the best way to plug yourself in to hear about this? Like, are there Facebook groups? Is there a group of people? Are there conferences specifically on this? Hey, you spent a long time doing this. What's the fastest way for someone to fail fast and fast forward, like learning as much as they can about this over the next few years? What are the resources you would recommend?
Yeah, that's a great question. Yeah, there's definitely groups online, communities you can join. There are conferences for note investing, industry conferences that we attend on a regular basis. And so getting out there, getting around groups of people that are like-minded in the same industry can be very powerful. And so I would recommend pursuing that. There's a number of great books out there as well, and online resources, communities, trainings, and starting with that is a great way to start without having to spend a lot of money. You can really start to get up to speed, learn about what questions you should be asking, and what ideas and concepts to prioritize first.
Awesome. Well, listen, Fred, thank you so much. This is, again, this is something that we've gone 45 minutes in here. Unfortunately, we're going to have to stop it. I've got a lot more questions I need to ask. So we'll bring you back in a year when I know just enough to be dangerous. And we'll ask you some more of that.
Yeah.
But in the meantime, Fred Moskowitz, thank you for coming on, taking the time today. I want to make sure people get a chance to read your book, The Little Green Book of Note Investing. If people want to hear more about you or more about what you're into or opportunities that you're looking at, what would be the best place for them to track you down and do that?
Yeah, thank you. Appreciate that question. The best way to connect with me is through my website, which is fredmoskowitz.com. And if you prefer a little bit of an easier spelling, you can visit giftfromfred.com. It'll take you right to my website. And once you're there, you can connect with me, send a message, learn more about the book. And you can also request, I have a special node investing guide that I'll offer to all listeners. Happy to send that out. Just go on the website and request that. And I always look forward to connecting with investors, learning about what everyone's doing, and building relationships, because it's a huge part of what we do.
I love it. Awesome. Thanks. Well, Fred, thank you so much for your time. We really appreciate it. Thanks again.
Thank you.
Thank you so much for listening and watching the Truly Passive Income podcast. If you liked the show, if you think it would be useful for someone else, the greatest compliment that you could give us would be to share the episode. Leave a comment down below or leave us an honest review. If you have any questions, don't hesitate to let us know down below. And remember, with truly passive income comes freedom of time, place, and the freedom to pursue your higher purpose.